Coming up today, financials lead the market to new highs. Wall Street getting even more bullish. What history suggests will happen next. Bezos sells billions of dollars of stock. The latest from AAPL. And who's going to pay for all this government debt? Grinding higher and higher, this market goes on a super low range today in this really high record gamma environment. Option dealers really suppressing the range and volatility here. Barely trading in a 15-point range today. There's a look on the SPY chart. One of the smallest candles we've seen in quite some time. Mid-cap's not looking as good though. Looking a bit soft there. And pretty much same old story on market breadth. Still looking a bit soft. New lows outpacing new highs today. VIX really suppressed as well. 12.5. And we've got some creeping volatility risk premium. However, that's mostly due to super low realized volatility. Market only moving at an annualized rate of 6.4%. And it was financials today, and especially regional banks. The winning sector up 1.8%. There's a look at NVDA creeping higher again, looking to come back and test the highs of this big bearish engulfing candle, I'd say. And look at Tesla, super strong. 6th consecutive green daily candle there. Looking a little stretch in the short term. We may consolidate and pull back. We got earnings coming out in 2 weeks from today. And since Wall Street analysts were so far behind, to start the year off, they're all revising their end of year targets higher and higher. Now got some saying we're going to 5,900 and we're already above the most optimistic forecast at the start of the year. And that's showing up in inflow into equities, the 5th largest on record current weekly inflow. And don't be fooled, it's not retail and small investors that are driving this market. In fact, retail traders only make up about 17% of all US equity volume, well off the highs from 2021. This is mostly institutional money, pension funds and the like, constantly pouring money into the market, just like I do myself actually. And Goldman Sachs is convinced there will be a soft landing, saying the US economy is slowing and normalizing, but it's not a complete slowdown. And we still have the top end of town rocking on, Apple breaking $3.5 trillion market cap for the first time, and Wall Street back on board, predicting huge growth for them is just around the corner on the back of a new iPhone upgrade cycle and the new generation of IntelliPhones integrating AI, as personal AI agents will become the next big thing. And there's a look at the S&P 500 year-to-date performance with and without mega caps. Dark blue's S&P 500, light blue is excluding NVIDIA, and without the Magnificent 7, the S&P would only be up about 4% year to date compared to about 14 where we are now. And here's another way to look at current market concentration. 5 largest stocks in the S&P 500 make up about 29% of the total index. That was surpassing the last high back in 1964, when we had AT&T, General Motors, Exxon, IBM, and Texaco making up about 28% of the S&P. However, so many people that invest today are convinced that's how you do it. Just buy all the biggest stocks that we all know and use every day. Apple, Google, Microsoft, because that's what's been working for years. That's all they've known, and they base their decisions on their own experience. And of course, we all suffer from recency bias. However, looking back in history, the largest 7 stocks of the S&P 500, if you were to systematically invest in them over the last 50 years, you would have underperformed the rest of the index here in the orange line. However, in late stage bull markets like the late 90s and the one we're in now, the top 7 stocks outperformed the rest of the market, and this time is quite a significant outperformance. A lot of people convinced that's going to go on in infinity. I beg to differ. And we may have a little bit of a weakness around the corner. Markets have run so well year to date, getting a bit ahead of ourselves in seasonality. And August is the worst month of the year for equity flows. Typically see people pull money out of the market, and September going into October can be a bit of a seasonally weak period for equities as well. Whereas July, and especially the first half of July we're in now, is a very bullish period. And that's pretty much been playing out to the book. We're also approaching some record highs, and the consecutive amount of days the Russell 2000 small caps have made a new all-time high back in late 2021, since the index has been at new all-time highs. But there is going to be a resurgence in earnings growth outside the Magnificent 7 to close that gap starting this quarter and set to accelerate into next year. And we're starting to reach some peaks in not only small caps versus large caps, but growth versus value. Back up at those levels, the 2000 peak, not to mention the 21-day correlation between growth and value at record lows. And not only on valuation metrics, large caps, growth stocks, huge gap with small caps and value stocks, technically as well. Just looking at a daily chart here of the S&P 500 ETF, and if I overlay that with the Russell 2000, you can see here, even in the short term, this last 2 months, got quite a huge gap going on. And if I zoom out to a weekly chart, it's even a bigger gap as well. Small caps versus S&P 500. And for sure, this could continue for some time yet. However, in my opinion, relative to large caps and growth stocks, small cap value is on sale right now. However, just like all the other previous market peaks, you'll see people pile in to to large cap growth stocks, as they're all drunk on recency bias, herding effect, and so they all missed it last time, and I'm sure they'll all miss it again. And a lot of the time in spiking unemployment, recessions, bear markets, you wouldn't think it, but small caps and especially value stocks have a tendency to outperform the rest of the market. And that's why I'm positioning my portfolio to benefit from that inevitability that, in my opinion, is just around the corner. And in addition to a softening consumer, weakening jobs market, we do have a rise in US bankruptcy filing starting to trend up as well, already tracking the highest year to date since 2010 coming out of the GFC. And long-term valuations of the entire market to GDP stretch at all-time highs. However, just keep in mind, a lot of these big tech stocks make a lot of their money offshore now. So just looking at the value of the American stock market to the American economy may not be a true picture, because a lot of American stocks are actually global companies. Some actually make more than half of their revenue offshore. But some of the biggest guys out there, like Jeff Bezos and Jensen Huang of NVDA, are offloading a lot of shares, more than they've done so in years. Bezos planning to sell $5 billion worth of stock, but still a small portion of his overall holdings. And so I think there's a good chance these mega cap tech large stocks could be due for a bit of consolidation, and we may see a bit of a broadening in the breadth. And I think that may have already started, looking at stocks that have been beaten down a lot in the tech sector like Intel, putting in some really strong price action and starting to make a bit of a comeback, finishing higher again today as they seek to also capitalize on the AI boom. And they're coming from a bit better spot of valuations, and it looks like the market has defended this $30 level pretty strongly here. We're also going to bounce back in electric vehicle stocks, led by Tesla out of nowhere, slapping on 40% in a few weeks, raising all year-to-date gains, catching a lot of bears and short hedge funds by surprise. Also seen Rivian and Lucid Group rising a lot the last couple of weeks. There's a look at Rivian, but the real leader is Tesla. Look at all that volume. Now back to a market cap, $836 billion. Moving on to Jay Powell. We got to hear from him testify in front of Congress. Pretty much straight down the line, nothing too different from what he's been saying lately. But I'd say his language is preparing for a cut, hinting that rates staying up here for too long could jeopardize economic growth. He acknowledged the labor market has definitely softened a lot the last couple of months. And all that to me sounds like he's prepping for a rate cut, at which I'd put it about 75% chance he does in September. And not only will these high interest rates keep hurting parts of the economy and jeopardize the growth of the economy, it could also jeopardize the growth of the government, as they're spending about $1 trillion a year now on servicing their debt, more than they spend on defense, and that's expected to explode going forward. And so you might be wondering, who's going to pay all that debt? Well, if you're under the age of 50, I'd be a bit worried about receiving a state pension, as looking back in history, when governments blow out their books, it's typically social welfare that's on the chopping block. And so if you're relying on your government to look after you in retirement, you may want to devise your own plan to become self-sufficient and not rely on the good hearts of those currently in power. But if you want to know a simple way to fix it, I agree 100% with Warren Buffett on how to end the US deficit in 5 minutes. You just pass a law that says anytime there's a deficit of more than 3% of GDP, all sitting members of Congress are ineligible for re-election. And so just like in the private sector corporate world, when you give executives a set of KPIs they must hit and link that to their compensation package, make 80-90% of their compensation performance-based, guess what ends up magically happening? Those KPIs get hit because their lives depend on it. So currently the deficit to GDP is around double that, almost 6%. And of course this won't happen because it's just too logical. There's just no accountability from our current day leaders. And we'll get another look at inflation this Thursday with CPI going into it. Long-term yields rising a little bit. Powell indicated he needs a few good more prints before he can pull the trigger. There's a look at JP Morgan's game plan on CPI day, putting the largest probability that month-over-month June CPI increase will come in between 15 and 25 basis points, and they think the market will trade up modestly if that were to happen. Over to commodities, we've got oil pulling back again, as we got the best case scenario from Hurricane Beryl. Didn't touch energy infrastructure at all. And there's a look at crude just pulling back, bouncing off my buy-sell band there. We've still got gold and silver sitting above the 50-day VWAP, not too far off 52-week highs. Also interesting now, the US now produces more energy than it consumes. And the green line here is production going all the way back to 1949, where it was briefly just above consumption in the dark blue. You can see that significantly caught up from 2016 going into 2019, and that's continued to climb ever since then. There's a look at the economic calendar. Not much out from the States today. Get Chinese inflation data in a few hours. Not much else out tomorrow. A few Fed speakers, but Thursday's the big one. CPI year over year expected to come in at 3.1%. Fear and greed index still neutral at 52, and Fed fund futures still given a 73% chance Fed's going to cut in September. And that's all I've got for you today, guys. Pretty quiet day in the market. Not a whole lot happening on a really low range day, and I'm super busy onboarding all my new members to my stock pick service. So I'm going to wrap it up there for today, and I'll be back tomorrow night for another daily market review. Cheers.